I have been thinking deeply about how fast the global landscape is changing, and now I am ready to explain what I believe is really happening. So, Iran closed the Strait of Hormuz, and instead of gold and silver exploding higher, both of them dropped. And then the not up, down. That alone should tell you that most investors still do not understand how this market actually works. The biggest geopolitical shock since 1973 hit the world weeks ago. Oil tankers have been attacked in the Persian Gulf. Energy markets have been rattled. Fear has spread across every major trading desk. And yet, instead of gold launching into a new panic rally, it pulled back. Silver pulled back even harder. Most people look at that and think the crisis is already priced in, or worse, that the whole thesis was wrong from the beginning. But that is not the real story. The real story is not that gold fell during a war. The real story is why it fell, what mechanism pushed it lower, and what every investor holding gold, silver stocks, or even a retirement account needs to understand before that same mechanism reverses. Because it will reverse, and when it does, the move could be faster and more violent than the early spike that caught everyone's attention. This is where Dalio Marco Mind wants you to look beyond the headlines and understand the machinery underneath the market. What matters right now is not the emotional reaction. What matters is the structure. When the first wave of war panic hit, gold surged, silver surged, oil surged. Retail investors saw those moves and did what retail investors almost always do during a shock. They chased the spike. They bought gold near the highs. They bought silver near the highs. They bought defense stocks near the highs. They bought oil names near the highs. And then the market did what it usually does after the first emotional wave. It reversed. Gold came off its peak. Silver dropped hard. Investors who bought the fear trade at the top suddenly found themselves underwater. Those who waited became confused. And financial media, after spending days shouting about huge upside targets, started asking why precious metals were not responding the way everyone expected. But the market was responding, just not in the way most people understand. Here is what was actually happening. The key number was never just the gold price itself. The key number was the move in bond yields. As oil surged and inflation fears intensified, Treasury yields moved higher. And that matters because rising bond yields are one of the strongest short-term suppressors of gold and silver prices in the modern financial system. This is the part most retail investors never get taught. When a geopolitical shock drives oil higher, markets begin to fear renewed inflation. When inflation fears rise, bond yields often rise with them. When yields rise, the dollar can strengthen. And when both yields and the dollar strengthen together, precious metals often get suppressed in the short term, even during a war. That is the mechanism. Oil up, inflation fears up. Bond yields up. Dollar firm, gold and silver pressured. So the same event that looked on the surface like it should have sent gold straight higher also created the exact short-term monetary conditions that can hold gold and silver down. That is why so many investors got trapped. They understood the fear. They did not understand the mechanics. And this is where the real story begins. Because when Dalio Marco Mind looks at this kind of setup, it is not looking at a failed gold rally. It is looking at the early stage of a larger structural move. History matters here. Go back to the 1970s. When the oil shock hit, gold did spike, but then it pulled back. It moved unevenly. It frustrated people. It made investors question the thesis. And only later, once inflation proved persistent and the monetary consequences became impossible to ignore, did the truly historic move begin. That is the pattern worth paying attention to. The biggest gains in gold did not come from the first moment of fear. They came later when the market realized the problem was not temporary. That is exactly why this moment matters. Because if the Strait of Hormuz disruption is not temporary, then the inflation consequences are not temporary either, and that leads to the first structural layer. Layer one is simple. The energy shock is not a one-day story. The Strait of Hormuz remains one of the most important oil routes in the world. A major disruption there does not just create fear headlines. It creates real pressure on energy flows, real risk premiums in crude, and real inflation pressure that can spread far beyond the Middle East. Every week that energy remains under pressure is another week that inflation stays harder to contain. And as long as inflation remains sticky, the Federal Reserve stays trapped. That leads to layer two. The suppression mechanism that pushed gold and silver lower in the short term does not last forever. It only lasts as long as markets believe the Fed can keep rates high enough for long enough without breaking something bigger. That is where the debt problem enters the story. The United States is carrying an extraordinary debt burden. Servicing that debt at elevated rates becomes more painful the longer rates stay high. So eventually markets begin asking the question that matters most. And there, and then despite died. Can the system really tolerate high rates for long enough to crush inflation completely? The moment the answer starts shifting toward no, the entire setup changes. Because once yields stop rising, or worse, once they begin falling while inflation pressure remains elevated, gold is no longer fighting both the dollar and bond yields. It starts benefiting from the exact inflationary conditions that the oil shock helped create. That is when the short-term suppression mechanism begins to reverse. And those reversals are rarely gentle. Now layer 3, silver. Silver always behaves more violently than gold because it sits in two worlds at once. It is a monetary metal, but it is also an industrial metal. So when fear explodes, silver can rally hard with gold. But when recession fears rise at the same time, silver can also get hit harder because the market begins worrying about industrial demand. That is why silver swings more aggressively. But a pullback in silver does not automatically mean the bull case is broken, because the bigger structural story behind silver has not disappeared. Physical supply has remained tight. Strategic demand has stayed strong. Industrial demand from sectors like solar, electrification, advanced manufacturing, and defense continues to matter. That means price weakness can sometimes reflect short-term liquidation, not the death of the larger thesis. That distinction is everything. Too many investors see a pullback and assume the story is over. In reality, sometimes the story has not changed at all. Only the price has changed. Those are not the same thing. And that is the mistake investors keep making in every precious metal cycle. They buy the emotional breakout. They panic during the structural pullback. Then they miss the larger move that comes afterward. Dalio Marco Mind wants to make one thing absolutely clear. The short-term price and the structural price are not the same thing. The short-term price is driven by liquidity, by bond yields, by the dollar, by positioning, by fear, by traders unwinding crowded moves. The structural price is driven by debt, by monetary credibility, by central bank behavior, by inflation persistence, and by the long-term loss of confidence inside the system. Most people trade the first one. Very few position for the second one. And that is why most people get shaken out before the real move even begins. The 1970s taught that lesson brutally. The people who only understood the first shock missed the full cycle. When was there were is the people who understood that inflation was becoming structural, not temporary, were the ones who captured the historic move. That is the real parallel. Not that gold should instantly explode and never look back, but that an oil shock, once it becomes embedded in the system, can become the first stage of a much larger repricing in real assets. That is the setup investors should be watching now. The signal is not whether gold performed perfectly in the first 2 weeks or the first month. The signal is whether the structural conditions have changed. Has the debt problem gone away? No. Has the inflation risk disappeared? No. Has the central bank pressure vanished? No. Has the long-term demand for real stores of value disappeared? No. If anything, the structural case has intensified, and that is why the market action has to be read correctly. This is not just a gold story. It is not just a silver story. It is a story about the gap between short-term price action and long-term structural reality. That gap is where the biggest opportunities often appear. Right now, one type of investor sees weakness and assumes the thesis failed. Another type of investor sees weakness and asks a different question. Did the structural foundation actually break, or did short-term market mechanics simply create a temporary window? That is the more important question. Because when a structural bull market gets temporarily suppressed by rising yields, a stronger dollar, and forced unwinding, what often opens is not the end of the move, but the accumulation window before the next phase begins. That is the part most people miss. They wait for perfect confirmation. By the time perfect confirmation arrives, the market is already much higher. So what should investors be watching now? Watch oil, watch bond yields, watch the dollar, watch the Federal Reserve, watch whether inflation pressure stays embedded, and most importantly, watch whether the debt-heavy system can really tolerate restrictive policy for as long as markets pretend it can. Because if it cannot, then the suppression mechanism eventually loses power. And when that happens, gold and silver stop trading like crowded panic assets and start trading like structural monetary hedges again. That is when the story changes for everyone who misunderstood this pullback. This is why the question today is not whether gold went up enough after the Iran war headlines. The real question is whether the deeper structural conditions that historically drove major precious metals rallies are present right now. And the answer, based on the logic of debt, inflation, energy disruption, and monetary pressure, is yes. That is the message most investors still do not see. They are staring at the short-term chart. They are reacting to the pullback. They are reading the market backwards. But the real move is rarely obvious in real time. It begins quietly, underneath confusion, inside volatility, while most people convince themselves nothing important is happening. That is where we are now. The market is not giving you a simple headline. It is giving you a test of whether you understand the difference between a temporary suppression and a broken thesis, a test of whether you can separate emotion from structure, a test of whether you can see the larger cycle before the crowd does. Most investors have no idea what may be building beneath this volatility. Now you do.